At the turn of the millennium, the internet was going to make everyone rich. Companies that had never earned a single dollar of profit were suddenly worth billions. 25-year-olds became paper millionaires overnight. The stock market went absolutely insane. And then, in a matter of months, it all came crashing down, wiping out around $5 trillion in wealth and destroying hundreds of companies. This is the story of the dot-com bubble, one of the wildest manias in financial history. Let's break down exactly how it happened. To understand the madness, you have to remember how new and magical the internet felt in the late 1990s. For most people, the World Wide Web was a brand new frontier, mysterious and full of limitless promise. Suddenly you could shop, read, and communicate through a screen. Visionaries declared that the internet would change absolutely everything, and they were right. But being right about the technology did not mean being right about the stocks. That gap is where the disaster was born. As excitement built, a gold rush began. Entrepreneurs raced to launch internet companies, often just by adding .com to a name and putting up a website. Investors, terrified of missing out on the next big thing, threw money at almost anything connected to the web. Venture capitalists funded wild ideas with little more than a slide deck and a dream. The mantra of the era was simple and intoxicating. Get big fast and worry about profit later. Much, much later. And this is the heart of the bubble, the fatal idea that broke all the normal rules of business. For 100 years, a company's value was based on its profits, on how much money it actually made. But in the dot-com frenzy, profits were dismissed as old-fashioned thinking. Instead, investors obsessed over a new metric: eyeballs. How many people visited your website? Growth and attention were everything. Whether you could ever turn that attention into actual money was somebody else's problem. Let's make that crystal clear, because it's the key to the whole story. Imagine a company that gives away its products for free to attract millions of users, losing money on every single sale. Under normal logic, that's a failing business. But during the bubble, investors saw those millions of users and imagined future riches, so they valued the company at billions. The price had completely detached from reality. People weren't buying businesses anymore. They were buying a story. Nothing captured the insanity better than the IPO frenzy. When a dot-com company went public, selling its shares on the stock market for the first time, the results were jaw-dropping. Stocks would double, triple, or quadruple on their very first day of trading. Companies with tiny revenues and massive losses were suddenly valued higher than established giants that had been making real money for decades. Wall Street was minting instant fortunes, and everyone wanted in on the action. The mania spread far beyond Wall Street and into ordinary living rooms. This was the dawn of online trading, where regular people could buy and sell stocks from their home computers with a few clicks. Teachers, taxi drivers, and retirees quit their jobs to become day traders, convinced they had found an easy path to riches. Everyone seemed to have a hot internet stock tip. When your barber is giving you stock advice, history says the top is near. At the center of all this stood the NASDAQ, the stock exchange where most technology companies were listed. As the bubble inflated, the NASDAQ index rocketed upward at a dizzying pace, doubling in roughly a year. It became the scoreboard for the entire internet dream. Every new record high fed the frenzy, convincing more people that the gains would never stop. The market had entered a state of pure euphoria. And euphoria, in finance, is always the most dangerous emotion of all. The spending reached absurd, almost comical heights. To build brand awareness overnight, .com companies blew fortunes on advertising they could never afford. The peak symbol of this came at the Super Bowl in early 2000, when more than a dozen .com companies paid millions of dollars each for 30-second commercials. Most of these companies had little revenue and enormous losses. They were torching the money investors gave them on a single night of advertising, hoping to buy their way to internet glory. The frenzy wasn't only in flashy websites. It ran deep into the plumbing of the internet itself. Telecom companies, convinced that web traffic would grow forever and instantly, borrowed staggering sums to lay vast networks of fiber optic cable across the world. They built far more capacity than the internet actually needed at the time. This massive overbuilding, funded by mountains of debt, created a hidden bubble inside the bubble, one that would collapse with devastating consequences of its own. Let's look at the poster child of the madness, Pets.com. The idea was to sell pet food and supplies online. The company became famous for its mascot, a sock puppet dog, which even appeared in a Super Bowl commercial. But the business had a fatal flaw. It was selling heavy bags of pet food online and shipping them for free, often losing money on every order. It was spending wildly on advertising while bleeding cash. And yet, for a while, the hype carried it. Pets.com was not alone. Webvan raised enormous sums to deliver groceries online, building expensive warehouses across the country before the demand existed. Boo.com burned through over $100 million to try to sell fashion globally, with a slow, glitchy website almost nobody could use. Across the industry, companies were spending money at a furious rate, confident that growth would eventually justify it all. They were building castles on sand, and the tide was about to come in. In fact, a warning had come years earlier from the most powerful financial voice in the world. Back in 1996, Federal Reserve Chairman Alan Greenspan famously asked whether the soaring market reflected irrational exuberance. It was a polite way of asking if investors had collectively lost their minds. The market shuddered for a moment, then shrugged it off and kept climbing for years. It's a perfect example of how, in a mania, even the clearest warning from the highest authority gets swept aside by greed. There was also a machine quietly pumping the bubble, the big investment banks. They earned enormous fees for taking companies public, so they had every incentive to hype even the flimsiest businesses. They would price an IPO low enough to guarantee a massive first-day pop, generating headlines and excitement, then ride the frenzy. Analysts who were supposed to give objective advice often cheered on the very stocks their own banks were profiting from. The whole system was tilted toward inflating the bubble, not questioning it. Behind the scenes, the warning signs were everywhere for anyone willing to look. These companies were losing staggering amounts of money with no realistic path to profit. Their valuations made no mathematical sense. A few cautious voices warned that it was an unsustainable bubble destined to burst. But in a mania, the skeptics are mocked and ignored. Nobody wants to hear that the party is about to end, especially when their neighbor just got rich. The euphoria drowned out all reason. The market peaked in March of the year 2000. The Nasdaq hit a towering all-time high, and the dot-com dream seemed unstoppable. But beneath the surface, the ground was shifting. Interest rates were rising, making borrowing more expensive and risky bets less attractive. Some of the most hyped companies began reporting results that revealed just how much money they were truly losing. The mood, almost imperceptibly at first, began to turn. The smartest money started quietly heading for the exits. What finally pricked the bubble was, in part, the Federal Reserve. Worried about an overheating economy and rising inflation, the Fed raised interest rates several times. Higher rates make safe investments more attractive and borrowing more expensive, which drains money away from risky, speculative bets. For companies that survived only by burning through endless cheap funding, this was poison. The easy money that had inflated the entire dream was quietly being switched off, and the timing for the dot-coms could not have been worse. The numbers tell the story of the insanity. At its peak in March 2000, the Nasdaq had soared past 5,000 points, having roughly doubled in just over a year. By the time the dust finally settled, it had collapsed all the way back toward 1,000. It would take around 15 long years for the index to reclaim its bubble-era high. An entire generation of investors learned a brutal lesson about what happens when price detaches completely from reality. Then the dam broke. As a few high-profile stocks stumbled, fear began to ripple through the market. Investors who had bought on pure hype suddenly remembered that these companies had no profits. The selling started, and once it started, it fed on itself. As prices fell, panicked investors rushed to sell before they fell further, which pushed prices down even faster. The euphoria flipped into terror almost overnight. The great unwinding had begun. It would be brutal. The collapse was savage. Over the following months, the Nasdaq lost a huge chunk of its value, eventually falling by around 78% from its peak. Think about that. Trillions of dollars in paper wealth simply evaporated. Stocks that had traded at hundreds of dollars crashed to pennies or to zero. The fortunes that had been created on screens vanished just as quickly as they appeared. The dream of easy internet riches had become a financial bloodbath. And the famous failures came fast and hard. Pets.com, the sock puppet darling, collapsed less than a year after going public, becoming the symbol of the entire bubble's stupidity. Webin burned through over $1 billion before going bankrupt. Bulldog com implodir sectacular lá. One by one, the companies that had been celebrated as the future shut their doors, laid off thousands of workers, and disappeared. The internet gold rush had turned into a graveyard. The human cost was real and painful. Ordinary people who had poured their savings, and sometimes their retirement accounts, into hot internet stocks were wiped out. Day traders who had quit their jobs were left with nothing, scrambling to return to ordinary work. Thousands of tech employees, who had been paid partly in now worthless stock options, lost both their jobs and their imagined wealth in a single blow. The euphoria of the boom curdled into widespread regret and ruin. And remember that hidden bubble in the telecom industry? It detonated too. Companies that had borrowed billions to build fiber networks now faced collapsing demand and crushing debt. The fallout was catastrophic. Global Crossing, which had spent a fortune wiring the world, went bankrupt. And the telecom giant WorldCom imploded in what became one of the largest bankruptcies in American history. The crash wasn't just about silly websites. It tore through the serious infrastructure of the entire industry. The desperation also exposed something darker: fraud. As the easy money dried up and companies scrambled to hide their losses, some crossed the line into outright accounting deception. WorldCom was caught fraudulently disguising billions in expenses to make itself look profitable. The collapse of the bubble peeled back the curtain on books that had been cooked to feed the hype. When a mania ends, it doesn't just reveal bad businesses. It reveals the lies that the good times had carefully concealed. What followed was a long, painful period that the tech industry remembers as the nuclear winter. Funding vanished almost completely. Investors who had been burned wanted nothing to do with internet companies. Promising startups starved for lack of money. Talented engineers fled the industry. For several years, the very word .com became a punchline, a symbol of foolishness and greed. The euphoric dream of the late 90s had curdled into a deep, lasting hangover that took years to shake off. But here's the most important twist in the entire story, and it holds the deepest lesson. The internet itself was not a lie. The visionaries who said it would transform the world were absolutely correct. The bubble didn't burst because the internet failed. It burst because investors had wildly overpriced it and funded countless bad companies along the way. The technology was real. The valuations were fantasy. Confusing those two things is one of the most expensive mistakes in all of investing. And out of the wreckage, a few survivors emerged that would go on to rule the world. Amazon, which sold books online, saw its stock crash by over 90% during the bust. Many declared it doomed, but it had something most .coms lacked: a real business, relentless focus, and a leader playing a long game. Amazon survived, then thrived, eventually becoming one of the most valuable companies on earth. The crash didn't kill the good companies. It revealed them. Amazon's survival is worth dwelling on because it was anything but guaranteed. At the depths of the crash, its stock had cratered, and critics openly mocked it as Amazon.bomb, predicting it would run out of cash and die like the rest. But its founder had raised money at the very peak of the bubble, giving the company a crucial war chest to survive the winter. He relentlessly cut costs, focused on customers, and kept investing in the future while everyone else panicked. Patience and discipline saved it. Amazon wasn't alone. eBay had a genuine, profitable model connecting buyers and sellers, and it endured. And in the very depths of the bust, a small search company called Google was quietly perfecting a way to actually make money from the internet, and would soon become a giant. The lesson is striking. The same era that produced the most ridiculous failures also produced some of the greatest companies in history. The difference between them came down to one old-fashioned thing: a real business. And from the ashes, the future quietly took shape. Google, founded just before the crash, didn't rush to cash in on the mania. Instead, it focused obsessively on building a search engine people loved and a way to make real money from advertising. It went public years later on its own terms and grew into one of the most powerful companies in history. The veterans of failed startups, including a famous group from PayPal, went on to build the next wave of giants. The bust cleared the ground for the real revolution. Because the internet, of course, did exactly what the dreamers promised, just on a slower timeline. The companies that emerged from the wreckage built the world we live in now. Online shopping, streaming, social media, smartphones, and the cloud. The dot-com bust was not the death of the internet economy. It was its painful but necessary growing pains. The dream was real. The mistake was simply believing it would all arrive instantly, and being willing to pay any price at all for it. So with the boom and the bust behind us, let's pull out the timeless money lessons, because they will protect you in every bubble to come. Lesson 1. Profits matter, eventually. You can ignore the fundamentals of a business for a while, riding hype and growth. But sooner or later, every company has to answer the simple question: does it actually make money? Any investment thesis that requires you to ignore that question forever is built on sand. Reality always sends its bill. Lesson 2. A great technology is not the same as a great investment. The internet changed the world, exactly as promised. And yet most people who invested in internet stocks at the peak still lost money. Why? Because they paid insane prices. Even the best, most world-changing idea could be a terrible investment if you overpay for it. When evaluating any hot new trend, separate the question of will this change the world from the question of is this stock priced sensibly. Lesson 3. Beware the new metrics that conveniently ignore profit. During the bubble, Wall Street invented creative ways to value companies that had no earnings, focusing on eyeballs, clicks, and page views. Whenever you hear that the old rules of valuation no longer apply, that this time is truly different, your alarm bells should ring loudly. Those exact words have preceded nearly every financial disaster in history. The fundamentals never really go out of style. They just get temporarily ignored. Lesson 4. When everyone is getting rich effortlessly, get cautious, not greedy. The most dangerous moment in any market is when it feels easy, when your barber, your cab driver, and your cousin are all making fortunes on stocks they don't understand. That universal, euphoric confidence is not a sign of opportunity. It is the classic signature of a bubble at its peak. The crowd is almost always most certain right before it is most wrong. Discipline beats euphoria. Lesson 5. Survivors are built on substance, not hype. When the dot-com tide went out, the companies left standing, Amazon, eBay, and others were the ones with real value, real discipline, and real plans to make money. Hype can lift you in a boom, but only substance survives a bust. Whether you're investing or building your own business or planning your career, ask what real, lasting value you are creating. That is what endures when the easy money disappears. And one more lesson, perhaps the hardest of all. Time, not timing, builds real wealth. The investors destroyed in the crash were often those chasing instant riches, trading frantically, borrowing to buy more, trying to get rich in a matter of months. The ones who came out ahead were patient, owned quality businesses, and could survive a downturn without being wiped out. In every bubble, the get-rich-quick crowd gets slaughtered, while the slow, steady, disciplined investor quietly endures and ultimately wins. Now here's why this story matters so much today. The dot-com bubble was not a one-time event. The exact same pattern, a revolutionary new technology, wild hype, insane valuations, and a brutal crash, has repeated again and again. We saw echoes of it in the housing bubble of 2008, in various crypto manias, and in waves of speculative tech stocks. The names and the technologies change. The human psychology behind the bubble never does. Every time a thrilling new technology appears, whether it's the internet, crypto, or artificial intelligence, the same forces awaken. The genuine excitement of real innovation gets mixed with greed, hype, and the fear of missing out. Prices detach from reality. The crowd convinces itself that this time really is different. Understanding the dot-com bubble gives you a kind of X-ray vision, helping you tell the difference between a real revolution and a dangerous, overpriced mania. Look closely at the artificial intelligence boom happening right now, and the parallels are impossible to ignore. A genuinely revolutionary technology has arrived. Excitement is sky high. Investors are pouring billions into AI startups, many with no profits and sky-high valuations, terrified of missing the next trillion-dollar giant. You hear the familiar phrases again. This changes everything. The old rules don't apply. Get in before it's too late. It rhymes almost word for word with the internet mania of 2 decades ago. Now, this does not mean AI is fake any more than the internet was fake. AI may well be every bit as transformative as the dreamers claim. But that is exactly the trap the dot-com era teaches us about. The technology being real and world-changing tells you almost nothing about whether a specific AI stock, bought at today's price, will make you money. Some of these companies will become the next Amazon. Many more will become the next Pets.com. The hard part is telling them apart. And the dot-com bubble gives you the framework to navigate it. Ask the timeless questions the crowd forgets in every mania. Does this company actually have a path to real profit? Is the price I'm paying justified by anything other than hope? Am I buying because I understand the business or because everyone else is getting rich? Those questions won't make you popular at the peak of the hype, but they are exactly what separates the survivors from the wreckage when the music stops. So the next time you see a hot new sector where companies with no profits are valued at billions, where everyone insists the normal rules don't apply, and where your neighbor is bragging about easy riches, remember the sock puppet. Remember the $5 trillion that vanished. The technology in front of you might genuinely be world-changing. But that does not mean the price you're being asked to pay makes any sense at all. Stay excited about progress, but stay disciplined about price. The dot-com bubble is a perfect, almost poetic lesson in the difference between a great idea and a great investment. It reminds us that markets are driven by human emotion, that hype and reality can drift dangerously apart, and that in the end, substance always wins. The internet did change the world, just as promised. It simply took longer and cost a great deal more than the dreamers at the peak ever imagined. And the people who understood that survived to profit from the real revolution. If you made it to the end of this one, thank you. This is exactly the kind of money story we live for on this channel. We break down the biggest bubbles, crashes, frauds, and comebacks in history, and pull out the lessons that protect your own money. Subscribe to Money Stories, ring the bell, and tell me in the comments, which of today's hyped-up technologies do you think is the next dot-com bubble waiting to pop? See you in the next one.